Hey folks, welcome to a product review at Finominal. Today we're going to look at two high profitability funds from DFA. So this is an ETF with the ticker DUHP, and there's a mutual fund, right, with the ticker DURPX. And both of these focus on selecting US stocks that rank high on profitability. Now, before we launch into the product review, it is worth reflecting why you'd want to select stocks based on profitability. And we can go back to, well, the Fama-French five-factor model, where profitability is one of the five factors. And we can look at this research piece where effectively we see the performance of the profitability factor in the US, Europe, and Japan. We can see picking high profitable stocks in Japan has not been that great, but in Europe and in the US, effectively investors would have been able to generate consistent excess returns. Now these are long short factors, right? So we can now investigate if this academic research translates into outperformance for investors. And before we look into performance, we're first going to confirm that indeed the stock selection process does what is expected in a sense of selecting stocks that rank high from a profitability perspective. And here's a few style boxes. We can see that these two funds from Dimensional, right, that focus on the high profitability stocks, right, that they're not very different from a valuation, market cap perspective, growth perspective, momentum perspective, to the S&P 500. Having said that, they are very different from a profitability perspective. So indeed, those funds provide the desired factor exposures. Having said that, we should also note that they have that the underlying stocks are not only highly profitable, they also rank high on leverage. And you can think about if that's desirable or not. Now, so this is from a factor exposure perspective. So the funds do what is expected of them. We can have a quick look at the portfolios, how they're constructed. So these are 181 stocks in the ETF and 149 in the mutual fund, compared to roughly 500 stocks for the S&P 500. If we do a quick overlap analysis, we can see that the ETF and the mutual fund, that there's an overlap of 82%, but the overlap to the S&P 500 is only 43%, respectively 37%. Now, finally, we can do a quick sectoral analysis, and what we see over here is that there are certain overweights to sectors. So, for example, the two funds, they tend to, well, slightly overweight consumer discretionary stocks, meaning they're more profitable, right? They tend to overweight healthcare stocks, industrials, but they also have an underweight to financials and to information technology, right? A slight underweight. And so there are some sectoral biases. Now, overall, we can conclude that these two funds have portfolios that have some overlap to the S&P 500, but there are also meaningful differences. Having said that, if we do look at the performance since 2002, we can, well, it's very actually difficult to differentiate the returns of those two funds and the S&P 500. Now, this is only about, well, 2 years of data or 3 years of data, right? And that's basically because the ETF has been launched in 2022. If we remove the ETF, then we do have a bit more track record because the mutual fund actually does go back in time to 2017, right? So now we have almost 10 years of data, right? Almost. But what we do see here is that the perspective does not change in the sense that selecting highly profitable stocks in the US stock market was not a winning formula. The performance is almost identical to the S&P 500. We can also look at this from a Sharpe ratio perspective. So the Sharpe ratios were, well, comparable, 0.67 versus 0.65. The drawdowns were comparable, -31 versus -33. And so that doesn't seem to be a meaningful difference. Now, that's interesting to think about, right? that if we go back to the academic research, right, we've seen this very consistent X return by sorting stocks, right, on profitability, versus if we do look at this from a product perspective, right, we do not see this consistent, nice positive X returns. There might be multiple reasons for that. One reason, typical reason is usually cost, but actually, to be fair to DFA, DFA stands for Dimensional Fund Advisor. The fees for this product is fairly low, 23 basis points. So that's unlike the culprit. It might be a function of the short side missing, right? Because this, of course, is only the long side, in the sense you select these stocks that are highly profitable, but you don't short the stocks that feature negative profitability. And that can also be one reason that explains the performance of the factor, right? Because it's a long short index. Now, that kind of concludes our analysis, right, of these two DFA funds that focus on selecting highly profitable stocks in the US. As mentioned, this selection process is backed by research, but we have to differentiate between the theoretical research, which focuses on long-short constructs, versus the products, which are long-only funds, right? And as we can see, there's a meaningful difference. Hope that helps. Have a nice day.